Hello learners, in today's lesson we will continue with the valuation of securities. As you know, in the previous lesson we learnt about the valuation of debentures and valuation of preference shares. Today we will learn about valuation of equity shares. As you know, prices of equity shares fluctuate very widely. N number of times they go up in a day and they come down in a day, or we can say there is a volatility in the share prices of the equity share particularly, or equity share prices in the market. Now you might be surprised why the prices of equity shares fluctuate widely. There are many reasons, but all those reasons can be put into two categories: fundamental reasons or fundamental factors and technical factors. Fundamental factors are like performance of the company, dividend paid by the company, future prospects of the company, management guidelines of the company and all that. And similarly, technical factors are the one which talk about day-to-day price movement, because in the technical analysis we believe that history repeats itself. That means whatever was the trend previously, same trend might get repeated in future also. Now I will be discussing or focusing on the fundamental factor, and one of the fundamental factors is how to find out the value of a share or equity share particularly for an investor who is either holding the share or who is expecting to buy the share in the market. You know, shares are issued by the companies in the IPO. You can buy in the IPO also, or you can buy in the market the shares which are available in the stock market. So let us proceed with the topic valuation of equity shares. Prominently, we will be discussing about two methods: dividend capitalization approach and earning capitalization approach. Dividend capitalization approach and earning capitalization approach. Dividend capitalization approach talks about the fact that an investor who is likely to buy the share of a company, then definitely he is ready to pay the capitalized value of the dividends expected by him. As you know, equity also has a feature that dividend on equity shares are not promised by the company. They keep on changing year to year depending upon the profits of the company. So what are the factors which contribute to the valuation of shares with the help of dividend capitalization approach? So the dividend capitalization approach is also known as Gordon's growth model, because Professor Gordon gave this model to value the equity shares. According to Professor Gordon, an investor is ready to pay the present value of the future stream of dividends which are likely to be paid by the company to its equity shareholders. Now, as we know, in equity shares nothing is sure. Company might give the dividend, might not give the dividend, or dividend will fluctuate from year to year. However, keeping into consideration certain assumptions laid down by the model, dividend growth model or constant growth model or Gordon's growth model, we can call it as by any name, but practically it is dividend capitalization approach. Now what are the assumptions of this one? Number one, dividends are paid exactly after 1 year from the date of purchase by the shareholder. So that is number one assumption. Number two assumption is subsequent dividends are paid at an interval of every 1 year. So that is second assumption of Gordon's growth model or constant growth model or dividend capitalization approach. Then dividend payments once started will not be stopped. That means year on year till the lifetime of the company, dividends will be paid. And lastly, he assumed that dividends might grow, because as we know, earnings of the company might grow in the future. Growth, if it is positive, we say it is good. Growth may be negative also. Negative growth means decline in the dividend. So he never put it that whether dividends will be growing, rising or declining. He simply talked about dividends might change. In this case, change is depicted by growth. Positive growth means rising, negative growth means declining dividends. So he assumed that dividends might grow at a constant growth rate year on year. If these assumptions are met, definitely we can use the formula given by Professor Gordon to value the equity shares of the company. Now what is the formula, you can say? The formula is simple. P0 stands for the price which an investor is willing to pay for a particular equity share. D0 is the dividend paid by the company on each equity share during the current year, which is called as present dividend or dividend per share for the current year. Alternatively, what we can do, we can call the P0 as VE also. D1 is expected dividend for the next year. That means if we are at the 0 time period today, exactly after 1 year, what dividend per share is expected by the shareholders from that particular equity share if they buy the share. So, that will be D1. So, D0 is the current dividend or present dividend per share, that is definitely amount in rupees terms, and D1 is how much dividend per share is expected by the shareholders for the next financial year. The alternatively formula can be like this also. So, P0 and VE both are synonymous for the value of equity shares. D1 is dividend amount per share to be paid in next year. D0 dividend amount paid by the company during the current financial year or for the current year, and KE. Now, here KE, few people call it as RE also. So, KE and RE are synonymous. Practically these two mean that how much is the capitalization rate of investor. By capitalization rate means if an investor is willing to buy a particular share, how much return he is expecting from that particular investment. Someone might expect 10%, 20%, 30% and something like that. So, KE stands for expected rate of return by the investor, and lastly small g is the constant rate of growth in dividends. So, these are the different parameters of the formula. Now, we can apply the same formula to get the value of shares. After understanding the basic parameters of this particular formula, let us practice 1 or 2 numericals in this session, and then we will proceed further with the next concept. If you see, we have an example with us. What is this? Dividend on an equity share expected to be paid next year, 3.5 per share. These have a face value rupees 10 each. Dividends are expected to grow at a rate of 6% till infinity. So, every year growth will be 6%, and then investor is expecting 17% return. Now, when we say the parameters are there with us, we have to find out what parameters are exactly given to us. 3.5 is the expected dividend for next year. So, that is D1 for us. Then face value will not be used in this particular question. G given to us is 6%, and KE, which is also referred as RE, is 17%. So, 6% to be written as 0.06 and 17% to be plugged in the formula as 0.17. If we use these parameters, we can definitely find out how much this investor is willing to pay maximum value for this particular equity share. So, let us plug in the values. Formula is D1 upon KE minus G. So, accordingly 3.5 divided by 0.17 minus 0.06. So, we get it 3.5 divided by 0.11. So, 3.5 divided by 0.11. So, 31.82. So, 31.82 is the capitalized value of the dividends expected by this investor from the current equity share given to us. So, this investor is willing to pay maximum 31.82 for this share. Let us proceed further for the next example. So, next example, as you can see, dividend on equity share paid during the year is 6.5. Pay the attention to the language of the question. This is current dividend. It means this is D0. In the previous one, we were given D1. Face value again will not be used. Dividends are expected to grow at a rate of 8% till infinity. So, constant growth rate is 8%, 0.08, and investor is expecting 20%. Now, if we solve this question, definitely we will find out the value this investor is willing to pay. So, D0 given to us is 6.5, G is 8%, so 0.08, KE, that is RE also known as 0.20. So, we can use the formula P0 is equal to D0 multiplied by 1 plus G divided by 0. KE divided by KE minus G. So, now if we plug in the values, 6.5 times 1.08 divided by 0.20 minus 0.08. So, what answer we get it? 6.5 multiplied by 1.08, we get 7.02 divided by 0.12, we get it 58.5. That means this investor is willing to pay maximum price 58.5, keeping into consideration the dividend forecast and the dividend growth. Now, whether this investor should buy it or not, it totally depends on the market trend. If in the market, current market price is less than the 58.5, the price calculated by us by using this formula, then definitely he should buy it. Because whenever current market price is less than the theoretical price arrived using the formula, then definitely share is underpriced, one should buy it. On the other hand, if current market price is greater than the 58.5 value, then he should not buy it. Rather, if he is holding, he can sell it, because according to him, share is overvalued. So, we always buy undervalued shares or underpriced shares. So, in case a share is underpriced, we suggest buy it. If a share is overpriced, we should sell it. If we are holding it, or we should wait for the price to correct to our optimum level, then we should buy it. So, that is the fundamental used by the people, those who focus on the dividend capitalization approach. Let us proceed further. Sometimes in the numerical we might not be given the growth rate in dividend, that is constant growth in dividend, but certain other parameters will be given to calculate the growth. Now, what are the parameters? If we see, when return on equity is given, that means how much earning company is making on the equity, ROE is given. And another thing is given, retention ratio. Now, what is this retention ratio? As we know, there is something called as dividend payout ratio. I repeat it again, dividend payout ratio. Dividend payout ratio means the proportion of the EPS which is distributed as dividend among the shareholders. If suppose dividend payout ratio is 30%, it means whatever is the earning per share of the company is distributing that as dividend among the equity shareholders. And retention ratio, remaining will be 70% withheld by the company for the reinvestment purpose. So, retention ratio is that proportion of the earning which is not distributed by the company as dividend, instead it is reinvested. So, that is what the retention ratio is. So, if retention ratio is given, we can use that also. If payout ratio is given, we can convert that into retention ratio. So, how we calculate the G? There is a one simple handy formula, B multiplied by R. B means retention ratio and R is ROE. By using that small formula, we can calculate growth in dividend. And as we can see, we are given, suppose B, that is retention ratio is 40% and ROE is 0.12. So, we can calculate the growth. 0.4 multiplied by 0.12. So, we get it 0.048. 0.048. It means according to this particular fundamental, dividends are expected to grow at a constant rate of 4.8% till infinity. So, that is the small formula sometimes given to us by the company or in the question. ROE, if not given, we can calculate. ROE is simply EPS divided by net worth per share times 100, or EPS divided by book value per share times 100. So, sometimes ROE is not given, rather we are given the parameter to calculate ROE, we can calculate that also. Let us proceed further. A company has 10 lakh equity shares. So, this is the question we are going to solve it out for growth calculation. A company has 10 lakh equity shares of face value 100 each. During the current financial year, the company has earned profit after tax of 60 lakhs. The net worth of the equity shares is 3 crore rupees. So, we have, now we can calculate ROE. So, we are given profit after tax of the company is 60 lakhs. Net worth, equity net worth is given to us 3 crore. ROE can easily be calculated. Profit after tax 60 lakhs divided by 3 crore times 100, we get an answer 20%. It means company is earning return on equity of 20%. Now, company has a practice of maintaining a dividend payout ratio of 40%. That means when DP ratio, dividend payout ratio is 0.40. So, retention ratio, which is B, 1 minus dividend payout ratio. So, 60% of the earnings are retained by the company. Now, calculate the value of equity shares of this company when general required rate of return is 26%. So, remember, growth in dividends is 20%, return on equity is 20%, B is 60%. So, first of all, we can calculate G, B multiplied with R or ROE. So, 0.60, because our payout ratio was 40% and ROE is 20%. So, 0.6 multiplied by 0.2, we get it 0.12, that is 12%. So, constant growth expected in these particular equity shares dividend is 12%. So, we have the basic parameters now. How much is the payout? So, by using that payout, we can get the current dividend, because we are given profit after tax 60 lakhs and there are 10 lakh shares. So, we need to calculate EPS also. So, remember those figures, we will proceed further with the calculation also. Now, we can calculate EPS. 60 lakhs divided by 10 lakhs, because profit after tax was 60 lakhs and number of equity shares were 10 lakhs. So, I can give you the formula also, profit after tax minus preference dividend divided by number of equity shares. So, in this case, we are not given any information about the preference dividend. So, let us assume that 0. So, 60 lakhs is the earning attributable to equity shareholders. So, we get an EPS of rupees 6, INR 6 is the EPS. And now, we can calculate dividend per share for the current year, because this is current year's EPS. 40% of the EPS is distributed as dividend by the company. So, D0 is 2.4. G we calculated 12% and investor was expecting 26%. So, all the parameters are there with us. We can calculate P0 is equal to, I will again write the formula for your reference. So, we get it 2.4 multiplied with 1.12 divided by 0.26 minus 0.12. So, what we get? 2.4 times 1.12. So, next year's expected dividend is 2.688 and we divide that with the difference between KE and G. So, we get it this value. $19.2. So, value of this equity share for the investor who is expecting 26% return is 19.2. So, that is the maximum price he is willing to pay for the share. Let us proceed further. I hope you could understand the things. You can have a recap. We simply calculated EPS because EPS was not given. So, EPS came out to 6. 60 lakhs was the profit after tax and number of equity shares were 10 lakhs. We assumed preference dividend is 0. Then DPS, dividend per share is 40% of the EPS is distributed as dividend. So, 2.4 per share. Growth we calculated in the previous slide and accordingly you can see the answer. So, that is the same example. We have the ready solution also, 12% growth is being shown and accordingly is there. So, that was their earning dividend capitalization approach. The second method or second approach for valuation of equity shares is earning capitalization approach. In general, investors and thinkers and the teachers use dividend capitalization approach. Maximum questions you will find on dividend capitalization approach. However, there is one more approach, earning capitalization approach. In this case, investors are ready to pay present value of future earnings. So, in the previous approach, it was investors are ready to pay present value of future dividends expected from the equity shares. But in this case, they are willing to pay only the present value of earnings because ultimately earnings belong to equity shareholders. Accordingly, value of equity shares will be EPS divided by KE, or in some cases when we are given growth rate, then definitely it will be P0 will be equal to EPS 0 multiplied with 1 plus G upon KE minus G. But pay the attention, in maximum cases this formula will be used. Reason being, we assume that all the earnings are distributed as dividend among shareholders. So, that is the basic assumption of this particular earning capitalization approach, that all the earnings are distributed as dividend to shareholders. Therefore, since no reinvestment is there, so growth is not expected to be there. So, basic formula is this. However, sometimes you might find this formula also. So, keeping into consideration this formula also, we can find out value of equity shares. We can practice one exercise on that. So, let us assume that earning per share is 6. Investors are expecting 21% return, that is 0.21 on their investment. According to earning capitalization approach, value of equity share for this investor is like this: 6 divided by 0.21, 28.57. So, there is one investor who is looking the share at this way. Another investor might assume EPS is 6%, but it might grow at a constant rate of 2%, and he is expecting 12% only. So, how much he is willing to pay? So, according to him, 6 multiplied with 1.02 divided by 0.12 minus 0.02. So, what formula I have used? I have used the formula P0 is equal to EPS multiplied with 1 plus G divided by KE minus G. So, that formula we have used because we are assuming growth is there in the EPS. So, accordingly 6 times 1.02 gets me 6.12 divided by 0.10. So, this investor says according to him value of the share is 61.2. So, these are the two prominent fundamental concepts for the valuation of equity shares: dividend capitalization approach and earning capitalization approach. So, that is basic part or universally applicable part of equity valuation. That is all in this particular video. In next video, next two video rather, we will practice the questions on valuation of equity shares and valuation of debentures and preference shares. Till then, keep on revising the facts which have been taught to you. Thank you. Wish you good luck.